Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, we're joined by Kent Draper. He's the Chief Commercial Officer of IREN. They just came out with Q1 earnings, and we've got a great list of questions for today's discussion. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. And let us know in the comments section below if you're currently holding shares of IREN and how you feel about this company moving forward. With that being said, let's get into today's interview. All right, guys, away we go. Kent Draper, the Chief Commercial Officer from IREN, hot off the heels of Q1 earnings. We just got back from our site tour at Childress, really a sight to be seen. We've got a lot of questions. Looking forward to the discussion. Kent, thank you for making the time.
Pleasure. Thanks for having me back on.
You're most welcome. Yeah, it's always good to see you. Obviously, a lot's been going on in the IREN world since our last discussion. We're looking forward to getting into it. But first, maybe we could talk about a few of the key highlights, whether financial or operational, from Q1.
Yeah, obviously a huge quarter for us, both from an operational perspective and financial perspective. Probably the single biggest element was our milestone partnership with Microsoft that we announced, a $10 billion contract over 5 years, providing them with GPU as a service, which we're hugely excited about. And then on top of that, we further updated the market on our plans for our targeted expansion to 140,000 GPUs by the end of 2026 across the whole portfolio, and that leading to 3.4 billion of targeted AI cloud annual run rate revenue by the end of 2026, which is obviously an enormous step change for the business that we're very excited about.
That's great to hear, and we'll come more onto that on that deal in a second there. Looking at the earnings specifically, great margins. Again, I think between 65-66% margins. That's looking at the power and some of the direct costs associated with the mining. So I don't think many miners are achieving that sort of level of margins there. You did have a big net income, and there was this unrealized gain on the cap call investment there. So that 655 million sort of helped that through there. That's probably, for those that don't understand, that's probably not a realized gain as such, like in the terms of you're going to benefit from that. That's just a provision that you've put in place to make sure any risks are adhered to. But very, very, over 2,000 Bitcoin mined in a quarter. I mean, you've got to be pleased with the growth of the mining business. In terms of, you set these targets out all the way through 2024, 2025, achieved every one of them. And now you're starting to set targets on high performance compute. And I don't think anyone's going to feel you're going to not going to achieve those. And we were very fortunate, like Bryce said, to go to the site and already see that infrastructure, Horizon 1, Horizon 2 being built. We can't say too much about the inside because we didn't take any photographs of the inside, but we can certainly see from the outside. And many investors, subscribers watched that. It was a very, very popular podcast to put out of the trip so far. So well done there. In terms of I noticed in the accounts the leasing you've leased I think 3,300 GPUs, and that cost, if I look at the 2 to 3 year period that the lease period's over, that's coming out at probably around about $60,000 per GPU. Can you sort of highlight what sort of payback would be required? I'm not sure of all. I don't know the depth of the revenues achievable with GPUs, especially these latest edition ones that you're going to be installing, Horizon 1 and 2. But can you talk about, what the payback is? Because obviously I see these big numbers. You've got to buy the machines as well. Yes, the energy is quite cheap, but how do you see the payback on these machines over the next sort of 3 to 4 years?
Yeah, so we announced over the past few months an expansion of the existing AI cloud service out to 23,000 GPUs. Out of those, we've contracted more than half of them, and most of those contracts have been entered into. So this is more than 10,000 GPUs worth of contracts entered into over the past sort of 6 weeks. So, first of all, seeing very good levels of demand in terms of the contracting, and the contracts that we've been able to sign for those, which are predominantly new generation Blackwell GPUs, have all been multi-year contracts, so 2-year contracts, and all coming out on average around a 2-year payback period. So obviously extremely favorable, and the way that we've been able to finance some of those purchases of GPUs through that lease financing is something that we think is very attractive as well. Obviously, non-dilutive financing in the sense that we're not having to raise any equity for it. There's a couple of different leases that are structured slightly differently, but what they effectively allow us to do is to be able to defer the cost of the purchase of those GPUs over a longer period of time, effectively matched up to the revenue profile that we'll be receiving from those GPUs. So it's a very nice way for us to be able to add incremental GPU capacity without stressing the balance sheet, without having to dilute through additional equity raising. And the rates that we're getting on that lease financing is very competitive. We're talking high single-digit financing cost, which, for the type of financing it is extremely competitive.
Yeah, that's awesome. Thank you.
Yeah, now I wanted to dig into the Microsoft deal. You said this is kind of the landmark deal of the year for IREN. Obviously made tremendous waves in the industry. Can you talk us through the deal itself, the process, and what this means for IREN strategically? I know at this point this is only a small percentage of your overall megawatt portfolio. Obviously opens the door for a lot of potential future growth opportunities.
Yeah, it certainly does. And I think, we've been in active discussions with hyperscalers for a period of time, before actually signing this deal. And as we'd stated to the market, exploring many different ways to monetize the land and power portfolio that we have. And most of the hyperscaler conversations tended to go to their preferred contracting method, which was co-location style agreements. But we were very deliberate in targeting moving up the value stack and positioning the Horizon data centers as being part of a fully integrated GPU as a service offering, rather than just data centers for lease. And so, I think as the conversations evolved with them over time, that was an important element for us. And I think one of the things that this deal does is, and a counterparty like Microsoft, they don't enter into these deals lightly. It was very, many months of detailed due diligence. And the due diligence that they did was on every aspect around our business, the business itself, the management team, the data center design, the site management, the delivery capabilities that we have, our ability to stand up large-scale GPU clusters and operate them. So it was a really all-encompassing diligence process. And I think, for us, the deal stands alone in terms of the economic outcomes, which happy to talk through in more detail. But in addition to that, it just gives us an air of credibility now. And even since that deal was announced, which wasn't very long ago, we've had a large amount of inbound inquiries, and the other discussions that we were already having with other hyperscalers, have significantly ramped up. So I think you're already certainly starting to see that come through. And it firmly positions us now as one of the largest neo cloud players. So I think it definitely takes us into a different stratosphere. And I think one of the key elements that was important for Microsoft was our vertical integration. So, we've been harping on about this as a key differentiator for the business, and that was something that they clearly saw as a value add. And particularly our delivery capability and our unique skills in that area. And one of the comments that they made repeatedly during diligence is that the way that we are delivering these data centers is incredibly time efficient while still achieving extremely good levels of performance out of the data centers and quality. And they remarked a number of times that the speed to market that we can achieve is something that they couldn't achieve themselves. So I think very good validation for us.
Now you talked about a deal with Microsoft there. They don't come bigger than Microsoft, to be honest with you. One of the attractive things about that deal itself, and I didn't think I'd see another one quite like it. We saw the CoreWeave giving the advance payments to Core Scientific. They've started to do that on the contract at their sites there. But this 1.9 billion due to be received by Microsoft. Can you sort of talk to us about the timing of that receipt and what that's going to be used for? Obviously, you've got to spend, I think it's close to $6 billion buying the GPUs itself, as well as building out Horizon 1 and 2. So there are some significant costs already underway and already about to be underway, because you're going to have to start ordering these machines. I don't know if you have to make any advance payments, but maybe you can put a little bit of colour to that type of overview there, please.
Yeah, no, it was a very important element of the deal for us, and something we spent a lot of time making sure that we got the structure right. So the Microsoft prepayments themselves are for 20% of the contract value with Microsoft. 20% of that contract value equates to 1/3 of the cost of the GPUs and ancillary equipment. And importantly, the timing of that prepayment is in advance of when we actually need to make the outlays for the GPUs themselves. So we think that puts us in a very strong position from a financing perspective. The project is going to be delivered in phases over the course of 2026. And in addition to the Microsoft prepayments, we were also able to negotiate with Dell that we only need to pay for the GPUs 30 days after shipment. So the prepayments are an important element, but then the rest of the CapEx is staggered over the course of the year as well. So it gives us ample time to be able to arrange financing. Obviously, Microsoft is a highly creditworthy counterparty, one of the absolute top names, not only in this industry, but out of any corporate entity globally. And so that puts us in an incredibly strong position on the debt financing side. We expect to be able to arrange significant amounts of GPU-specific debt financing at very attractive rates. And then any incremental amounts of funding that we'd still need to provide, there's a range of options for us on those as well, whether it's convertible notes, other forms of corporate debt financing against data center assets. So, we just, the way that we've structured it gives us a lot of optionality around financing in ways that is not going to be dilutive from an equity perspective. So, thanks for asking the question, because I think it is an underappreciated element of the deal, and something that we spent a lot of time on.
And also, I didn't see any sort of equity going towards Microsoft, so maybe that was another key part of that discussion point.
Yeah, it was one of the key elements. We've seen a number of these other co-location deals signed now, where people have given up significant portions of their business through warrants or other forms of equity. And that was something that we firmly believe that we shouldn't have to do in order to get one of these contracts. We think our platform stands on its own 2 feet in terms of the service that we can deliver to them and our capabilities. And obviously they saw it the same way and were willing to enter into a contract without us having to give up any of that additional value. So that's a very important element from a shareholder perspective. And also, I should point out, we didn't have to give up any options over future capacity associated with this deal as well, or options for extensions and things like that, because that's a factor that you see in a number of these other deals. And obviously, anytime you're giving up optionality, somebody else is getting value for that. And we were very firm again in our belief that we shouldn't have to do that to be able to secure this deal.
Well, we'll get on to that expansion potential topic in a second here, but one of the criticisms of the CSP or GPU as a service model, Kent, has been that significant upfront CapEx costs. And you've just talked about some of the strategies IREN has already entailed to, I guess, give you guys more flexibility in those upfront purchases. Can you talk to us about the life expectancy of these GPUs after that initial 5-year contract? How do you guys model that out? And as a part two to that, one thing we heard consistently at the site tour was keep in mind the lifespan of a GPU versus the infrastructure, the cooling buildings, the data centers. These are drastically different. The infrastructure has decades of usable life. So can you talk to us about, I guess, that concern, the residual value of the GPUs versus the infrastructure?
Yeah, sure. So maybe starting with the GPUs. I mean, from a technical perspective, if you're operating these things and maintaining them properly, and you're operating them in good conditions, which we will be, I mean, they'll have a technically useful life of 10 plus years. They'll run for a long time. So it really comes down to what is the economically useful life. And I think, we're obviously in a position today where there's an enormous demand supply imbalance in terms of availability of compute. And we don't think that is going away over the short to medium term. And so, certainly from a demand perspective, we think there's going to be continued demand for these chips. I think the current state of the industry is instructive as well. If you look at A100s, those are over 5 years old now. They're 100% utilised across the industry, still achieving very good rates of return on their initial capital outlay. H100s are three years old now, again, 100% utilised across the industry. So we certainly think that these GPUs are going to have a useful life beyond the 5-year contract with Microsoft. But importantly, from a modelling perspective, I mean, the returns are still very attractive, even with no residual value. So we spent a bit of time on our earnings call talking through the assumptions there. But if you're looking at the investment in the GPU CapEx and the returns we're earning there, with very conservative assumptions around debt financing, you're getting to a mid-30s equity IRR, which, in any sense, I think is a very attractive return. And that is, as I said, with conservative debt assumptions and zero residual value assumed for the GPUs. Now, if you add in any residual value on top of that, are able to achieve better than the conservative debt financing we've assumed in there, obviously your returns increase significantly. So, we do think that, on all fronts, that this is a very good standalone deal. As it relates to the GPU and CapEx infrastructure, I think this is, one of the elements that the market has had a hard time understanding. And what a number of people are doing is just bucketing the data center CapEx in with the GPU CapEx, running the returns over a 5-year time period and only looking at that, which makes no sense because, as you pointed out, the useful life of the data centers is 20 plus years. So, that's why in our earnings call, we try to bucket it out into the distinct portions, looking at the the return on the investment on the cloud side of the business. So this is a GPU infrastructure, and then looking at the returns on the data center infrastructure separately, because they're just inherently very, very different pools of CapEx, and you can't just bundle them together and look at the revenues over a 5-year period and analyze it that way.
I think you've already said in the that you're going to depreciate buildings over 20 years anyway, so that sort of like, you know, puts credibility on that point you just made there. One thing that impressed us at the site when we did the Childress tour last week was the repair centre. You know, and having that, and to be honest with you, a lot of PM miners also have repair centres, especially at the flagship sites where there's a lot of activity going on. And I think there was well over 20 technicians working that repair centre. So you can see, you know, these machines, the Bitcoin mining machines, are working 24/7, 365 days a year. When you work in machines that hard, there are inevitably going to be, you know, some fixes. Some could take 5 minutes, 10 minutes, an hour. Some might need a bit more maintenance, and that's why you have, you know, the various levels of technicians working there. Switching that across to GPUs, these are very expensive machines. What are you finding? And bear in mind the number of ticket items across machines in all the sites we visited was very, very similar in terms of, you know, per exahash. So we know that, you know, there's no simple way. You're going to have to, you know, make these repairs. Now with GPUs, we don't know too much data on those, but you've been running GPUs in British Columbia for some time now. What can you tell us about the sort of like, do you have backup repair on site? What's going to happen at Childress to support Microsoft, and also about the training of staff to, you know, they've been fixing mining machines, but I mean, I'm not a technician person, but I'm assuming if you're spending $60,000 on a GPU, it's a bit more technical, maybe needs some additional training. What's IREN doing to plan for the outcome of that? And I might have got it all wrong. You might not need anywhere near the amount of repairs, so please tell me if I'm right.
Yeah, so there's a whole bunch of elements that go into it, and it is fundamentally different technology to ASICs. First and foremost, I think we pick very reputable OEM partners. So this specific deployment is with Dell, obviously one of the most reputable names in the industry, huge balance sheet behind them. Extremely good technical prowess. They've deployed a number of liquid-cooled systems at very large scale, and so they absolutely know what they're doing in terms of designing and deploying and installing this equipment, which is a fundamental factor because you obviously want as few equipment failures as possible in general, and making sure that you're using a reputable OEM is an important part of that. Secondly, at a site level itself, we deploy a number of different operational processes to ensure smooth operation. We have on-site full spares of all major equipment. And when I say full spares, I don't just mean the individual parts. We actually have redundant units that are sitting on site. And these can be deployed either via full rack change out, or each rack has individual trays, which are effectively, if you imagine like a drawer and a set of drawers, you know, you can just pull it out and insert a new one. So there's very good ability to change out equipment in short order at a site level. In terms of repairs, we go through a thorough training process with our staff. It's actually one area where there are more similarities than you would expect with ASICs. So, you know, while it's different equipment, a lot of the internal circuitry and the replacement methodologies that you use are actually quite similar. The diagnostics that you perform initially. So we do go through additional training to bring the staff up to a level that they can do AI repairs, but fundamentally having that repair shop on site is very helpful. And then the warranty provisions and replacement for AI is very different to Bitcoin miners. You effectively get a full 3-year warranty with your initial purchase on the GPU side. That includes full repair, replacement of parts. Again, it's one of the reasons why doing it through a very reputable OEM like Dell is an advantage. They get you next business day delivery of any parts that fail. And so, you can see there's as I said, a whole number of elements to it, but we feel very well positioned in terms of what we're doing, and obviously have substantial experience having run a cloud service for over 18 months out of our BC facilities.
Hey, now getting back to the expansion question here, you guys just signed your Microsoft deal. Already people are looking at the next possible deal. You've announced up to Horizon 10 at that location, so a lot of potential there. We saw a massive property and substation, obviously future-proof or ready. You mentioned you did not give Microsoft any extension or preference optionality on future megawatts. So can you talk to us a little bit about the situation you're in now? We've seen a lot of these kind of co-location deals announce increases in megawatts. You guys seem to be kind of in the driver's seat in terms of how and where you want to expand next.
Yeah, I mean, we've got a very favorable position in the, as we've discussed before on this show, we've been doing development for a number of years, and we've always thought of that as a fundamentally important part of the business, because we never came at this originally from the perspective of just Bitcoin mining. The play for this business has always been that there are going to be multiple different digital use cases. And going right back to our seed deck, we pointed out Bitcoin mining alongside AI and machine learning, as well as a number of other potential use cases. And the theory always was, in the digital world, as you know, you get these exponential growth curves over very short periods of time, whereas the real world is a multi-year development cycle, and it takes years to get the infrastructure in place. And because we've always had that in mind, we've built up this very large portfolio of assets. And to put it into context, a Microsoft deal is only 10% of our power across the portfolio today, and that's close to $2 billion of annualized revenue run rate. And I mentioned, earlier on at the start of this pod, that by the end of next year we're targeting a $3.4 billion annualized revenue run rate. That is only utilizing 16% of our secured land and power portfolio. So it gives you an idea of the true potential of the portfolio here. But we're very excited. As you mentioned, we've got the opportunity to continue to roll out additional liquid-cooled data center capacity at Childress. Sweetwater 1 is still on track for grid energization in April of next year. That's 1.4 gigawatt side. Sweetwater 2 still on track for grid energization late 2027. That's an additional 600 megawatts. We've got a lot of demand that we continue to see. Since that Microsoft deal was announced, that has only increased. So, we're excited about the prospects for the remainder of the portfolio and what we can do there.
Couple of points on Childress. I mean, Dan's probably been asked to death about, are Microsoft going to be increasing their footprint there? They are a hyperscaler. My question is a different question. Are there any provisions to prevent any other hyperscalers going onto Childress with Microsoft sat there in Horizon 1 and 2, with being a co-location there, in terms of you having 2 or 3 or 4 different entities on the same site? That's the question I'd like to put forward to you, Ken.
Yeah, no, there's nothing contractually prohibiting us from doing that. Obviously, any of these sort of entities are very focused on security, and Microsoft is no different with that. But the Horizon 1 to 4 area will all have its own separate set of security. and we have some of the best security practices in the industry. This is all specific, access keys in terms of being able to access data center buildings, or recorded, logged, security cameras everywhere. So as long as you're providing that secure footprint for the customers, no, there's no restriction on what else we can do with the remainder of the site.
That's great. Horizon 1 to 4, from my calculations, is probably going to need about 300 megawatts to deliver that in terms of the PUE as well. The site's 750. You're using, I think, 510 for mining. So obviously the calculations going through my mind at the moment is that it doesn't mean you're going to be able to fulfill that full exahash. I think it's 40 exahash, the largest Bitcoin mining site maybe in the world, but certainly North America on one site. I suppose what I'm trying to say is, where do you see the planning sort of over the next 2.5 years? Is the mining great for cash flow now, but the focus may be in the future to use power directed towards HPC? I mean, I don't even know what the price of Bitcoin is at the moment. It's dropped so much over the last sort of 3 or 4 weeks. And this is the issue, that not just IREN, and you're probably getting some of the best margins, but most other mining companies aren't getting those margins. And you can see now we've not had a number of CEOs saying 2 to 2.5 years, we're out of the game. We're looking at HPC. Where do IREN sit on that? I mean, you are producing, Bitcoin at a good margin. The last account said 66% margins. Where do you see that in 2.5 years' time?
Yeah, look, it's always hard to project 2.5 years out in this industry. That's an eternity given how fast moving everything is. But I mean, today it is still very cash flow positive for us, and I think we are unique in that regard. We've got one of the lowest power costs in the industry. We've got the most efficient fleet out of the listed miners. We've got a very high level of operating uptime relative to nameplate capacity because of the high quality infrastructure that we build. And all of that sort of leads to still, achieving very good levels of profitability when many others are, struggling to. So it is still cash flow positive for us today. We did, as you're aware, a number of months ago announce that we were pausing further expansion of Bitcoin mining in order to focus on AI. And as we build out to the 140,000 GPUs over the course of 26, that will take up some of the capacity that is currently used for Bitcoin mining. Importantly, though, it'll be staggered over the course of 26. So Horizon 1 and 2 actually won't displace any Bitcoin mining capacity. Once you get to Horizon 3 and 4, we will need to displace some capacity. And as we add incremental AI up in British Columbia at Mackenzie and Canal Flat sites, that will eat into the GPU capacity. But it's over the course of 26. And even then, at the end of 26, if we expand to the full 140,000 GPUs, we'd still expect to be at around 35 exahash and possibly more, because AI is not, unlike ASICs that just operate pretty much at full capacity the whole time. AI tends to operate below full capacity and also has some swings, and there may be some interesting things we can do in terms of using the curtailable Bitcoin mining load to just fill in the gaps. So we're still planning that out. Who knows? As I said, 2.5 years from now, it's hard to tell. Bitcoin's got this habit of just when everyone is most disappointed in it, it rips and surprises everyone on the upside. So we'll see. But as of today, we're just seeing such good opportunities in the AI space that it makes sense for us to continue to focus our efforts there.
As a sort of like chief commercial officer, I mean, are you keeping a sort of a watchful eye on the latest machines coming out? We're now seeing single-digit terahash machines coming out in terms of, joules per terahash in terms of efficiency, which is significantly lower than your fleet efficiency at the moment, which is at 15, which is effectively the best fleet efficiency of all the public miners out. Let's be clear about that. But But there now are a couple of suppliers who are bringing out machines lower than double digits in terms of joules per terahash. Are you keeping a watchful eye on that? Because I know from the accounts, again, I think some of the T21s looking to sort of maybe take them offline next year. And I think you've already applied the depreciation for that sort of transaction as well through the accounts in this quarter, allowing for that. So can you sort of like talk about that, or is really we're not looking to buy more mining machines? We're looking to utilize what we've got as we grow AI at the same time.
Yeah, more the latter at the moment. As I said, we're just seeing such good opportunities in AI today that it makes sense to focus there. Having said that, we've always stated that we're not going to be too dogmatic about what we're doing. At the end of the day, our job is to try and achieve the best returns for shareholders. And, we do have capabilities across 3 different verticals today, being Bitcoin mining, AI cloud services, and AI co-location. And we'll continue to monitor all of them. If it ever gets to the point where something changes very significantly, maybe we'll reconsider the current strategy. That's how we've always been, and something we'll continue to do moving forward.
Thanks, Kim.
Now, moving on to power pipeline, specifically certainty around power pipeline, we've talked about this SB6 ruling with a number of different CEOs and teams, some talking favorably about it, saying, hey, you know what, this is really going to clear up maybe some of the fake quote unquote competition in the queue, get some of the people out of this line that shouldn't be there. Other people have said, hey, this could have potential concerns or additional requirements to submit applications for people that are already in the queue. Can you talk to us a little bit about SB6, the ERCOT market itself, and any additional hurdles, steps that are needed to be done in order to get Sweetwater 1 and 2 online?
Yeah, I think as it relates to SB6, our take on it is certainly that we think it will be helpful overall. There's sort of 2 major elements. So one is dealing with behind the meter sites, which we don't have any of. So that portion of SB6 doesn't really apply to us. All of our sites are grid connected, and that was a purposeful decision that we made because we just think grid connected firm power is a lot more valuable than behind the meter generation, where you're taking single generator risk and have some of the complications associated with that. And then the other element of SB6, as you mentioned, or other major element, was trying to clean up the queue for connections. And we think, we're obviously a highly credible player in the space. We're a real developer. We're not speculative. We're not just going out looking to, try and put options on all sorts of land parcels and make a quick buck by flipping them. And that is unfortunately what you're seeing with a lot of the capacity that is in the queue. It's people who are never actually intending to build out or develop these sites. And so that is creating significant amount of headaches for ERCOT and other grid operators, because they have to treat all the load requests at fair face value. And it's very difficult because they know that a lot of that is speculative demand. And they're already stressed in terms of their ability to be able to process what's in front of them. And they just continue to see more and more of these speculative requests. So I think anything that puts the onus on developers to be able to show that they actually have site control, to put down deposits that actually show that they have a legitimate interest in developing these sites, we think is favourable. But importantly, most of what has been proposed in ERCOT really applies to new projects, right, and new developments. Sweetwater is something that has been in the queue for a long time, and our grid studies were approved in 2022. To give you an idea of how long we've been working on that project for. So, most of the impacts that we're seeing are really more targeted on future projects and affecting, new greenfield projects today, rather than stuff that people have already been working on for a long time.
Now, in terms of you have 3 gigawatts, I mean, that's going to fill up the next, 4 or 5 years in terms of working to get those completed. But I'm sure that you've got a team looking at beyond then, and maybe not necessarily in the US. Are you looking in other areas outside of Texas? Texas seems to be quite congested at the moment, but are there any other potential areas, even other locations outside the US that you're considering? Because unlike Bitcoin mining, there's not as much sensitivity around the power costs to deliver HPC than there are against Bitcoin mining. If you're mining at, say, over 5 cents, it's a problem. But with HPC, you don't have that level of power intensity, and therefore it's still obviously a cost, but it's not as, when you're looking at your power cost being 2% of the revenues, it's not as sensitive. So is there any sort of like, because now you're, building things at scale, could you scale outside of America?
Yeah, so a couple of points on all of that. So we've always been conservative in terms of our announcements to the market around grid capacity. We only announce it to the market once we've signed a binding connection agreement that gives us security of supply. So the 3 gigawatts that we've announced is all of that nature. These are binding signed grid agreements. However, we've been doing development of projects consistently over the last 6 years. And so we have projects at a variety of different stages in the development process that we expect will continue to fill up the portfolio after this initial 3 gigawatts. And certainly that's a very large portfolio that we've been able to build up. In terms of the jurisdictions, we still really like North America. There's a lot of favorable aspects to it, but we are expanding or targeting jurisdictions that we haven't previously operated in within North America. And then certainly looking outside of North America as well. Asia Pacific as a market we've been active in for a while, and also looking at other potential jurisdictions as well. In terms of the power cost, yes, you're right, it's less sensitive, but it is still an important factor. And I think, for us, there are still a number of broader development objectives that we will continue to adhere to. So, we like OECD countries, we like countries that have political and regulatory stability, well understood electrical markets, colder climates preferred, not an absolute must, given liquid cooling, but obviously your PUEs are more effective in cooler climates. And then, we power all of our data centers with renewable energy. So areas that have an abundance of renewable energy or are undergoing a transition towards a lot more renewable energy, those are the characteristics that we look for. But yes, we're active in a number of other markets.
Sounds like UK ticks most of those boxes, but time will tell.
Hey, last one for me, Kent. You talked about the colder climates, the lower PUEs. That's reminding me of Canada up here. It's getting colder into the winter months. I just wanted to get an update on your BC locations. I know a lot of excitement, a lot of development there. You're building them out, adding GPUs. It sounds like from a contractual basis, people are snapping these up as quickly as you can plug them in some cases even before activation. Can you just give us a high-level summary of BC operations and what's going on there?
Yeah, that's right. Still seeing very good levels of demand there. Over the past number of weeks, we've contracted for around 10,500 GPUs worth of contracts in advance of when they're getting installed. And that's a big deal because historically customers have been reticent to pre-contract for capacity. They've wanted to wait right up until the time that it's installed. And I think, one, that's obviously instructive of the level of demand. People realize if they don't pre-contract, they may miss out. But secondly, I think, a number of the customers that we're contracting with are repeat customers that we've built up a level of credibility and trust with, and they know when we say we're going to deliver something by a certain date that we will do that. And so, that's been extremely helpful for us. because by pre-contracting, it gives you additional confidence to go out and purchase more GPUs and continue to feed into the demand that we're seeing. In terms of the sites overall, so the 23,000 GPUs that we've already ordered, that will effectively fill up the Prince George site. And so we've already started the infrastructure modifications that are required at Mackenzie and Canal Flats in order to be able to accommodate GPUs at those sites. And we expect to be able to accommodate up to 40,000 GPUs across the course of 2026 at those two sites. So that'll put our BC fleet at over 60,000 GPUs, which is extremely sizable. And certainly from a Canadian perspective, we think those are the largest deployments around. So we're very excited about that. A lot of the capacity is going to be the newest generation NVIDIA Blackwells that operate extremely well in our facilities. And I think one thing that gets overlooked a bit with BC is because we built very high quality data centers there originally and effectively overspec them for Bitcoin mining, it's a very low capital cost to upgrade these data centers. The actual just pure cost of conversion to switch them over is very minimal. And then, the one thing that we consider is whether we want to add redundant backup power generation, which we probably will across most of the sites. That costs about $2 million a megawatt. So when you take both the CapEx cost and the GPU cost into account, you're seeing revenue payback periods of just over 2 years, which we think is just an incredible economic proposition across that size of fleet. So we're very excited about those facilities.
That's great to hear. You mentioned earlier in the conversation about the opportunity now with having a partnership with Microsoft to deliver that service. You're going to be able to attract more favorable rates in terms of notes, in terms of convertible bonds. Now, it looks like from the recent earnings, you've utilized, I think, most of the ATM that's in place at the moment, and great that you did, because the share price since April really went on a sort of like a tear, effectively, getting up towards $80. That's still an important lever available. I'm assuming IREN will be announcing maybe another ATM just to have that in place as a backup. You've used it effectively over the last couple of years. There's no reason why you'd want to stop doing that now, unless you were able to get all the funding through converts and raising debt that way. But what's the company's thoughts on another ATM just as another lever?
Yeah, it's one of the sources of funding that is available to us, but it's one of many sources that is available to us. You mentioned convertible notes. That market still continues to be very good. It's an extremely attractive form of financing, long-dated instruments, very low cost of capital. We like the fact that it can convert into equity at some point in the future, because we do want to continue to maintain an appropriate mix of debt and equity within the business and not over leverage ourselves. But having said that, today we have very low levels of leverage overall within the business. And there's plenty of other sources of funding available that are non-dilutive, whether it's other forms of corporate debt outside of convertible notes, either secured or unsecured, additional GPU debt financing. We have zero debt against any of the data center assets, and that's billions of dollars worth of tangible asset base today. So lots of levers available to us. We will, as I said, be sensible in terms of the mix of debt and equity going forward. But there's a lot of non-dilutive sources of funding that are available to us.
Yeah. Final point for me is obviously fantastic to be able to visit Childress last week. One of the things that we learned from the site there is the amount of personnel that have been recruited from the local areas, which is obviously one of those great things about bringing an industry to an area that's probably needing sort of jobs there. How are you finding that recruitment? How are you finding the level of staff as you now move into this sort of AI HPC space away from the mining space?
Yeah, I mean the team's done a great job on the delivery side of being able to source a lot of labour, and I think this is one of the advantages of having been continuously delivering in infrastructure for multiple years. Is we've been able to build up relationships, we've been able to build up a labour pool. We're not just doing the individual contracts and then everybody disappears. It's an ongoing build out, and it's one of the advantages of having large individual sites. It's one of the advantages of having multiple sites located in a single state, relatively close to each other. Is now that we built those relationships and that labour pool, we can just continue to utilise that across all the sites and expand on it where we can. And utilising local labour has been incredibly important for us. And, to be honest, we love it. I mean, the people in these communities are fantastic. They care deeply. It brings you a level of engagement at an employee level that you don't often get, when people don't have the same level of care. And if you think about, where our projects are located, these are in regional areas, most of them been very hard hit over the past couple of decades from withdrawal of industrial or manufacturing operations, and being able to bring these huge future-proof projects out there has just been an enormous benefit to those communities. It's created jobs, it's created economic stimulus. We're a huge property taxpayer. We provided a lot of training for the local population in terms of jobs. We work very closely with local educational institutions. We have community grants programs. We were able up at Mackenzie to fund half of a more than $1 million build out to bring additional internet bandwidth and high-speed bandwidth into that town. So, I mean, we're thrilled to be a part of these communities. They're fantastic communities, and we hope that they love having us. Certainly, the feedback that we're getting indicates that they do. But we're excited about it, and the prospect of finding labour moving forwards is one of the continuing challenges in this industry. But we've been very successful in the past, and hope to be so moving forward here.
No, I honestly had a fantastic day, and I must have shook more hands than a politician that day. Amazed at how many of the people working there actually watched the podcast. So that's really a really nice tick in the box. And no, hope to get to visit Childress again when you've got more of the story to tell. There's obviously a lot of moving balls, and we're grateful that you spent some of the time in a busy period to come on the podcast today, Ken. You're always welcome on the podcast. And it's just been amazing just to sort of having been there last week and now discussing about, what's going to happen going forward. Really appreciate it.
Yeah, pleasure. Always enjoy having these conversations, and look forward to the next one.
Excellent. Hey guys, hit the like button. Feel free to subscribe. If you have any additional questions for the team at IREN, let us know in the comment section below. Kent, thank you so much for the time. We'll talk to you soon.